Hello and welcome to the lecture for the first part of Chapter 5. So this chapter is a little bit more complicated, so please note that there are 3 different homework assignments for this chapter rather than how I've been doing it so far, which is 2. So in this part of the lecture, I'm going to talk about different inventory flows, so ways of calculating the cost associated with what we get a customer and what's left on the shelf. So I'm going to talk about that in detail today. And then the second part of the lecture for this chapter, I'll talk about the lower of cost or market rule, a little bit about inventory control and fraud, and then about estimating ending inventory. So in the last chapter, we had problems where they told us that we sold, let's use an example, goods costing $5,900 to a customer for $9,000, where $9,000 is the selling price and $5,900 is our cost. But we never explained where that $5,900 came from. And so that's what we're going to talk about in this chapter. So if you're running a business and you pay the same exact thing for the inventory you have, let's say the bookstore that we've been using as an example, the used university bookstore, if every student that came in, we paid $10 for their textbook, then it would be really simple math to figure out what the cost was when somebody purchased one. But in reality, we pay different amounts for the inventory we purchase. As an example, in the beginning of the semester, when not many books are being sold and we're not desperate for them, we may pay $8 a book to a student. As the semester goes on, we might start spending $10, and near the end of the semester, when we're really nervous about having enough books for next semester, maybe we're paying $15. So now we have inventory with those textbooks on the shelf, and they're at 3 different prices, $8, $10, and $15. And so when somebody comes in next semester to buy one of those textbooks, which one are we giving to them? That's the question we'll address in this chapter. So as things are purchased at different costs, which certainly happens just as a result of inflation for most businesses, we have to figure out which item it is that we sold to the customer. And we do that through a couple of different methods, which I'll explain in more detail. But we assume a particular flow through the inventory for accounting purposes. It doesn't necessarily have to match the actual physical flow of the goods, although that tends to tell us the most accurate story of what happened in a business, but it's not a requirement. And I'll talk about that in a few minutes here. So as an example, we've got 3 different purchases here, the May 10th, May 18th, and May 24th. And we bought goods for $9, we paid for one, $13, and then $14. So we've got 3 items in inventory with a total cost of $36. Now let's assume we sell one of those items for $20. Well, if I assume that it's the oldest one that I bought on May 10th, well then my cost of merchandise sold is $9. My inventory is the other 2 items, which is $27. Notice that 9 plus 27 equals 36. That's my total cost. So the cost of merchandise sold and the ending inventory together are always going to equal the cost of the total amount of goods that were available to be sold. If I assume instead that the item was the one I bought on the 18th, well then I have a cost of merchandise sold of $13 and ending inventory of $23. And likewise on the 24th, cost of merchandise sold of $14. Ending inventory of $22. In all cases, that adds up to $36. But again, it's about associating which item went to the customer. So there's 4 different methods I want to talk about. The first method is actually the best method from a matching standpoint, and that's specific identification. That's where I can identify the exact item that a customer purchased, and I know what I paid for that item. So a car dealership is a good example of that. There's a VIN number on every car, a vehicle identification number. So when I purchase a car, I can know what did I pay for that car for that particular VIN number. You come in to buy one of those cars, I know which one I'm selling you, I can record the exact cost. That's the best method, but it's really difficult to do in a business like a grocery store or Home Depot or Macy's or any other kind of retailer. It's difficult to do. It really only works with infrequent sales of large high-ticket items that are unique. So now let's look at what most businesses do. So the first is actually the most popular. Most people use this method, and it's first in, first out. So what it's saying is that the oldest item in stock is going to be the first one given to a customer. So I have an example of milk cartons there. So milk is loaded from the back, and so the newest ones are always in the back, and the oldest ones are always in the front. So customers come and take their milk from the front, unless, like me, you reach to the back to get the better stuff. But most customers take from the front, so they're taking the oldest items, and newest items are being loaded from the back. So in this case, I'm going to assume if there's inflation, like we showed in the previous example, that the customer is going to get the oldest, cheapest item. Now we can contrast that with LIFO, the exact opposite. That's assuming that the last one is the first. The last one in is the first one to go out. So in this case here, I'll look at bark for your yard, gardening bark. So when you drive your pickup there to get a load of bark for your garden, they're not going to dig down to the bottom to give you the oldest one first. They're going to take from the top. So they're adding to the top of the pile and taking from the top of the pile. So in that case, when you drive there with your pickup, you're going to get the newest, freshest bark given to you. And maybe nobody ever even sees the bottom of that pile because you're always adding to it and taking away from it. So in that case, the oldest stuff is what is remaining in inventory, and I'm giving customer the newest stuff. So in the case of inflation, that might be the most expensive stuff. So the last method that I want to show you is my favorite, and that's where we just mix everything together. So the example here is a gas station. They buy gas at $2 a gallon. A couple days later, they buy some more gas at $2.20 a gallon. A couple days later, they buy more gas at $2.40 a gallon. Then you show up at the day after that, you fill your tank. What gas are you getting? You're getting a mixture of all that gas. The reason I like this the most is I've found in my experience that it's the easiest method to explain to people that don't know anything about accounting. They don't think you're trying to play some trick or something. So I like it for that purpose. It also kind of takes out the highs and lows because it's going to give you, in the case of FIFO, if there's inflation, you're giving customers the cheapest stuff, so you have the lowest cost of goods sold. LIFO, you have the highest cost of goods sold with newest stuff. Weighted average gives you a point in between. So it can kind of smooth out the highs and the lows. So let me show you a little bit more complicated example for these three methods. So this first one here, it's a bicycle shop. So I start with 10 bicycles that are $200 each, and then I go out on March 18th and I buy 20 more bikes at $220 each. And let's say I've got a storage unit where I'm loading them in from the back side and customers take them from the front side. So I keep loading them in the back. And then on August 21st, I make a second purchase, 25 units at $250, loaded from the back. So I've got a total of 55 bikes that I purchased, total cost of $12,650. Now let's assume I sell 43 bikes on September 1st for $350 each, okay? Well, I'm going to give customers the oldest stuff first. And again, this is the cost flow assumption. The physical flow doesn't have to be the same. But let's just, for illustrative purpose, assume that it is. So I give customers the oldest bikes that cost me $200 each first. That's not enough to satisfy their order. That's only 10 bikes. So I have to give them the whole first purchase as well, another 20 units. That's still not enough. So I need to dip into the second purchase to give them 13 bikes to reach the total of 43. So when I look at those layers of cost, I have a cost of $96.50. If I had 25 units in that second purchase and I just sold 13 of them, it means that my ending inventory is 12 units because all my beginning inventory is gone, all my first purchase is gone. I'm left with just 12 units of my second purchase at $250 each. So that's $3,000. I can add $96.50 and $3,000 and I see I get $12,650, so it's a good way of double checking my math. Now we'll look at the exact opposite flow. So in that case, I still have the same purchases, but in this case, let's pretend that I'm loading these bikes into a storage unit that only has a door on the front. So if my first purchase goes in, it goes all the way against the back wall. the beginning inventory. My first purchase goes in front of those, second purchases is in front of those. So the second purchase is closest to the door, okay? And I sell 43 bikes. Well, now I'm going to give the customer those 25 that I just purchased at $250, and then I'm going to have to dip into the first purchase and give them 18 to give them their total of 43. So that gives me a cost of $10,210. Then I look at my ending inventory, and I know that I have the remaining 2 units in my first purchase, and I still have all 10 units from beginning inventory that are at the back of that room at $200 each. So my ending inventory comes to $2,440. I can add that together with my cost of merchandise sold of $10,210, and I see that I get $12,650 again. Notice that the cost of goods sold is higher with the LIFO method when I have inflation because I'm giving customers the newer, more expensive stuff. So why would a company choose this method? Because most of the time we deal with inflation. Well, they might choose this method because with a higher cost of goods sold, that would mean I'd have lower net income. And if my main concern is reducing my tax expense, that would reduce my taxes. So if I'm a single owner business and I'm not trying to impress anybody with my net income, I just want to pay less tax, this method would allow me to do that if I'm in an inflationary situation. So the last method we'll use is weighted average. So in that case here, I'll look at my inventory, the first purchase, the second purchase, I'll add it up. I bought 55 bikes and I spent $12,650. So that works out to an average of $230 each, okay? So I will apply that amount by the 43 bikes I sold. That's $9,890. And my ending inventory, 12 bikes sold, 12 bikes remaining at an average cost of $230 for $2,760. So again, I can add those two numbers up and see that I get $12,650. So my math is probably right. So in this scenario, we're pretending that we just mix all the bikes together in a big pile and pull some out for the customer. So they're getting a mix of all 3 different layers of inventory in that case. So that's enough information to help you with exercise 5.2 and 5.3, which is your first homework assignment. I'll also record and upload a video of working through the B versions of those problems. So if you have any questions, please don't hesitate to shoot me an email. Thank you very much. Bye-bye.